Does inflation help you pay off your debts faster? Imagine paying off your debts with money that is worth less than when you borrowed it. Sounds strange, right? Well, inflation can actually make this happen in some cases. When inflation rises, the overall prices of goods and services go up, which means your money doesn't stretch as far. If you have a fixed-rate loan, like a mortgage or a personal loan with a set interest rate, inflation can work in your favor. Because the amount you owe stays the same, but the value of money decreases, paying back that loan becomes easier in real terms. You're essentially paying back with dollars that are worth less than when you first borrowed them. But it's not always that simple. If your debt has a variable interest rate, inflation can make things trickier. When inflation goes up, lenders often raise interest rates to keep up with the rising costs. This means your loan interest could increase, making your payments more expensive. So, instead of helping you pay off your debt faster, inflation might actually slow you down if you have a variable rate loan. Inflation also impacts your overall finances. As prices go up, your day-to-day expenses increase too. This can leave less money available to put toward paying off debts. If your income doesn't rise at the same pace as inflation, it becomes harder to keep up with payments. Central banks often respond to inflation by raising interest rates, which makes borrowing more costly. This can affect new loans and even existing variable rate debts, adding to your financial burden. Credit card debt is another area affected by inflation. When inflation pushes interest rates higher, credit card companies often follow suit. This can mean higher monthly interest charges, making it harder to pay down balances. Many people find themselves relying more on credit to cover everyday costs, which can lead to even more debt. So, if your income increases along with inflation and you have a fixed-rate debt, you might find it easier to pay off your loans faster. But if your income stays the same or your debt has a variable interest rate, inflation can make paying off debts more difficult. It's important to understand how inflation impacts both your income and your debts to manage your finances wisely during inflationary times.